Hello, scholars. Welcome to IRS YouTube channel. Here, where we break down accounting topics into simple and practical learnings you can use to succeed in your field of study as a financial accounting. So, today we'll be looking at control account in financial accounting and how important control account is in financial accounting. So, I'll welcome you once again to iOS YouTube channel. Please kindly like, comment, and subscribe to our YouTube channel. There are also other things that you can learn from our YouTube channel, such as tech or other difficult courses and research tips. So, but here we are treating control account. Okay, let's start with what is control account. Control accounts is a memorandum account which are transferred into totals, the various amount of transaction which has been debited and or credited in details to individual ledger accounts. Here, the most important concept in this control account is the word memorandum, the totality that's involved in control accounts. Control accounts is deal with two important concepts, and the two important concepts here is total creditors and total debtors. This is what makes control account to be different from other accounts is control accounts only take care of credit transactions. Transactions that takes place without immediate payments are what goes into control account. And this credit transaction we are talking about, what we need there is the total, the memorandum, the totality of all that credit transactions is what we are talking about when we are dealing with control accounts. So the two aspects of control account that we have is total credit control account and total debtors control account. Sorry, let me come again. Total creditors control account and total debtors control account. Why do we have this? Control account is a periodic account. Yeah, it's a periodic account. It takes place once in a year. And we are dealing with these control accounts in the sense of totality, total, summary, aggregate of all credit transactions. When we are talking about cash book only take care of cash transactions. But the opposite the case when we are dealing with control accounts. In control accounts, it take care of only credit transactions. And the credit transaction there are going to be in total amount, not like we are dealing with individual ledger accounts. That's why total control account deal with the total or summary of individual ledger accounts that involve credit transactions. So what I'm trying to say here is that you have to understand the concepts and the idea behind what we call control accounts by taking care of it by looking at credit transaction that does not involve immediate payments. That is what we do in control account. And before I move on to the next slide, I want you to understand that a control account can be easy for you to understand when you have the idea of an intermediary or a middleman that's involved into a trade. For every business or for every production, there will always be a middleman or an agent. For example, if you are a trader, you are the middleman. That means for you to be a middleman, you have to buy from the producer and make it available for the final consumer. So either you are buying or you are selling, there will always be a credit transactions from the buyer or from the producer, and there will definitely be a credit transaction from the customers. So that is where the idea and the concept of debtor and creditors control accounts comes from. So even a manufacturing company or the producer itself is always be a middleman. Middleman in the sense that the manufacturing or the producer will also buy raw materials to produce the goods and make it available in final goods to the person that is going to consume it or to the customers. So in some cases and some circumstances, The manufacturer or the producer can also get the goods on credit or the raw materials on credit from who? From the raw material manufacturing company. And it can also make the goods available on credit to who? To the customers. And those are the two aspects that control account is talking about. But here it's talking about the totality. We don't have interest in individual ledger accounts. What do I mean by individual ledger accounts here? Individual ledger account is just like when you are dealing with bookkeeping, daily bookkeeping. That's individual ledger account. For example, if you have something like Mr. Tunde is owing you 10,000 naira, Jide is owing you 20,000 naira, Titi bought a goods that was 20,000 naira from you. You mentioning their name or keeping that records on daily basis is what we call individual ledger. But we don't have interest in the individual ledger when we are dealing with control accounts. What we have interest in total amounts that people are owing you are the total amount that you are owing people. We are less concerned about how much you are owing your supplier. We are less concerned about how much you are owing the source that you are getting your raw materials for, or we are less concerned about the individual name of the company that you are owing. But what we have interest in control accounts is what is the totality of the amount that you are owing. What we have interest in control account is what is the totality amount that your customers are owing you or that your clients are owing you. Now, this is where the concept and the idea of debtors and creditors is going to come in. As an accounting student or a student that is doing accounting, probably financial accounting, you should be able to differentiate between what we call total debtors and total creditors. Who are the creditors? Who are the debtors? These are the questions you're supposed to ask yourself. Then, to our individual or the intermediary or the trader, which is always be an intermediary person. A trader is an intermediary person that will get the goods from the producer or from the supplier and make it available to the consumer or the final unit or the client. Now, here, people that are owing you are the people that you are going to, they are the group that are going to be under debtors accounts. So any names or any monetary value that's associated with debtors accounts shows that the individual there are the one owing you. The reverse the case when we are talking about total creditors accounts. The names of the people or the organization under your creditors shows that you are the one owing them. Please note again. Now, what I'm trying to differentiate for you is the debtors and creditors. And these are the aspects or the most important aspect of control account. So the debtors are the people that are owing you. Then the creditors are the people that you yourself you are owing. So in any business or any transaction, there will be cash transaction and credit transactions. But credit transaction is our priority when we are dealing with control accounts. Cash transaction is our priority when we are dealing with cash book accounts. But here today, we are dealing with control accounts. So with this, I believe that you're supposed to understand the introduction of what we call control account. When you are defining control account, probably you are given an assignment, or probably you have an exam, probably maybe an ICANN exam, or higher institution exam, or even SSCE exam. When you are asked to define control account, please make sure that memorandum account is stated in your definition. At the same time, totality of an account, which is the totality of what? Credit transaction from what? Individual ledger accounts. So then I'm going to move to the next slide. Let's see what is in the next slide. Okay, now uses of control accounts. Why this control accounts is so important in financial accounting? Firstly, it helps us to locate errors. You can see that the first one is location of errors. Control account aids the location of error. Error in the sense that the clerk is the one that's going to take care of individual ledger. So, and if an accountant is the one that's going to take care of control accounts. So, and these control accounts is used to be taken care of once in a year, periodically. But the one prepared by the clerk, by the ledger, or the subsidiary books is taking place on a daily basis. So by the time we prepare our control account, we need to compare it with the subsidiary books. So if the balance in our control account does not equal to the total amount we have in the subsidiary books, then we already know that there is an error or there is a mistake in preparing of the subsidiary book. So that will help us to locate an error. Then it helps us to prevent fraud. You can see that the second important here is prevention of fraud. Through control account, fraud cannot be easily penetrate here. So you have to look at because we have another body that is going to prepare control account. Another body is preparing the subsidiary book. The clerk is responsible to prepare the subsidiary book. An accountant and satisfied accountant is the one that is going to prepare what we call control account. So that control account serves as a check on what? On the ledger clerk that is preparing all these ledgers or the subsidiary books that we are talking about. So by the time that there is an imbalance between the ledger and the control account, then we know that something is going on, because the person that is going to prepare the ledger, once that person is aware that, oh, they are going to cross-check this on the control account, it is easy for them to prevent what we call fraud. Then it also serves as an internal check on the ledger clerk. Yes, I've explained this in the previous uses. So control account operates as an internal check on the ledger clerk. So here we have easy detection of missing figure. Easy detection of missing figure. And that's like when we are talking about its minimize error. It helps us to easily detect if there is a missing figure or any ways of error. Then preparation of interim final accounts. It's very, very important for the final account, because in our final accounts, where we are preparing the statement of financial position, what we need is the totality of debtors and creditors. We don't need the individual name of the ledger. So it helps us to prepare our final account. So that's that for the uses of control account. So now I'm moving on to the next slide. Now, classification of control accounts. This is where I'm talking about. I said we have just two classification of control accounts, where we are talking about the total debtors control account or total creditors control account. Don't forget, in the introduction part, I explained to you that in business arena, we definitely have two parties that are involved when we are talking about credit transaction. Two parties were involved in credit transactions. What are the two parties? The debtors and the creditors. So when a transaction takes place without immediate payment, transaction that take place without immediate payment shows that we have two parties involved in that transaction. The two parties is the debtors and the creditors. The person you are owing is a creditor to you. Then you that you are owing the person, you are a debtor to that particular person. I don't know if how I'm going to explain this. Let's assume that three persons are involved in a transaction, and you represent the trader, and you have a supplier, which is another third party, and you have another party, which is your customer. So you as a trader, you can purchase goods on credit from your supplier. That shows that your supplier is a creditor to you. So your customer that also bought from you on credit, that kind of person is a debtor to you. So the person that is owing you is a debtor, and the person you are owing, those people that are owing, they are your creditors. So please bear that in mind. So that debtors and creditors is now what we classify into what we call total debtors accounts and total creditors accounts. Note that control account deal with totality, total, summary, aggregate. So then we now have the classification, we have this division of control accounts. So if you look at this, the total debtors control accounts can also be called sales ledger control account. I repeat, total debtors control account can also be called sales ledger control account. What am I saying? Before you can involve yourself having debtors, that shows that you have already made the sales, or you make sales of some goods on credit. That's why you can categorize such people or such transaction as debtors. If you don't make any sales, definitely there won't be debtors. If you don't make any sales on credit, there won't be debtors. If you don't purchase any goods on credit, definitely nobody is going to be your creditor. So it's when sales take place on credit, then we have what we call debit transactions. Then we have what we call debtors control accounts. So that's why the other name we can call debtor control account is sales ledger control account. When sales take place, as a trader, you sold goods on credit to your customer, then it shows that that customer is your debtors. Then transaction takes place. Then as a trader, you purchase goods on credit from your supplier. That transaction takes place on credit too. Then it's known as total creditors account. So other name for total creditors account is purchase ledger control account. That means you purchase on credit, that's why they are your creditor. Another name for total debtors account is that you make the goods available on credit, or you sold the goods on credit, that's why they are debtors to you. So I don't know, I wish you get the logic or the ideas I'm trying to explain to you here. So for the sake of this class, so we are going to look at sales ledger control account, and we are going to look at purchase ledger control account, where sales ledger control account is also known as total debtors control account. Then purchase ledger control account, which means they are telling us that you purchase these goods on credit, and those people are your what? They are your creditor, and that's why the other name is called total creditors control account. So here is the format for sales or debtors ledger control account. Then we are going to analyze this format before we move to the key terms of this format. So if you look at the debit side, you can see that there is a sign there that is the positive sign in red color. Then if you look at the credit side, we have a negative sign there in red color. This is just a simple idea or simple format that you need to know when you are preparing control accounts for both sales and purchase ledger control accounts. Now, I will advise you that whenever you are dealing with any financial accounting, don't try to cram the format. Don't try to cram the format. It affects a lot. If you cram, you probably you might forget when you get to the exam hall, or when it's necessary for you to apply it, you can actually forget it. But the most important thing, and where we are here for you as iOS, is that we want to explore you, and we want you to understand the concepts behind each financial account. So when you understand the concept, you don't need to cram before you know where you're supposed to post this particular account. And that's what we are doing here. And that's why the first class of this class is to explain the concepts to you before we do the practical, or we solve an example for you based on this control account. Now, if you look at this side for the sales or debtors ledger control account, this side that is positive shows that this debit side, which is positive, it indicates that any transaction that is coming to this side is going to increase in the debts. Then if you go to the other credit side, which is negative, any transaction that is coming here will be reducing your debts as the trader, where you have debtors and you have creditors. Let me repeat myself. This is just a simple logic behind control account. And then what is the simple logic I'm talking about? Your debit side, which have a positive sign here, you put this positive sign at the back of your mind. When you are solving this question, you don't need to put positive or negative there. Just have this thing at the back of your mind that anything that is coming to your debit side will always be positive, adding to the debt, adding to the existing debt. Then the one here will always be negative, which is going to reduce the amount of debt that you have. So let's go. Which is going to reduce the amount of debt from your customer. You are not the one owing them. If it is under creditors account, that is when you are the one in debt. So, but under debtors account, people are owing you. They are debtors to you. It is an asset to you. Okay, it's not a liability. So let's move on. So the positive sign here, I repeat that it serves as indicator that shows that any element that is coming here is really increasing my debt. Now let's start. The first concept that we have here is balance brought forward. Although at the back of this slide I've explained everything, so I'll need to explain by showing you the format. So the positive sign here shows that we have balance brought forward. Balance brought forward here is telling us that, let us assume the account we are preparing is 2025. But in the previous accounts for the previous year, they realize that you are still owing, you realize that people are still owing, or you have a remaining debt from your debtors that from the last or previous years. So bringing that amount forward to this new year or the new year account is what we call balance brought forward. The remaining balance for the previous years is what we mean by balance brought forward. Please get this right. When we are talking about balance brought forward, means the remaining balance for the previous year of account. And when you want to prepare the new year account, you need to brought the amount forward to the new year. And that's what we call balance brought forward. So this shows that this debt is already exists. So it already exists, and that is an additional debt. So it indicates that my debt is increasing. So let's move to another one. The next concept here is sales credit. This sales credit means that you make like the goods or services or whatever you render it on credit. That is, you sold the goods on credit, and that means the debt is still increasing. Although they are still owing you before, and yet you still make goods available for them on credit again. That is increasing the debt. For example, Mr. Okafo is owing you 5 million last year, and you brought that 5 million to this year. So again, Mr. Okafo still comes to you and asks for a goods that are worth 10 million again in new year or new year of account. So you need to add that 10 million that you make available for Mr. Okafo in form of goods and services with last year balance of Mr. Okafo that is still owing you. That's going to make about 5 million last year, 10 million this year, and that's going to make 15 million. That indicates that Mr. Okafo debt is increasing. So Mr. Okafo has a debtors if the debt is increasing for you to use. Please, I believe you understand this concept. So now we move to interest charge on overdue accounts. You know, when we are talking about interest charge on loan, it's going to increase your debt or increase the debtor's debts. So dishonored bill will also increase the debt. What do we call bill? Bill is just like example of bill is check, what you can present as a means of payment. It's in form of a bill. So the best example I can use now is check as a bill. But a check can be dishonored, and once it is dishonored, that means it is not allowed, it is not honored, it is not accepted, which shows that your debt is still remain the same or your debt is still increasing. So you see, the concept I'm explaining on that debit side is increasing the debt. Now let's move to the concept of the carriage outward. Carriage outward is part of the organization expenses. Like the seller still incurs some expenses in form of transport for the goods and services, which indicate that is still going to add to your money that you are owing the seller. Carriage outward, we have carriage inward and carriage outward. So carriage outward is the cost incurred by the seller to the customer in form of transportation of the goods and services. So if that is going to be increasing your debt. For example, I'm using Mr. Okafo example. As in Mr. Okafo debt now is 25 million, and the cost of transporting the goods to Mr. Okafo company or residence worth 10,000 naira. That shows that 10,000 naira will still be added up to Mr. Okafo debt, which shows that Mr. Okafo debt keep increasing when we add carriage outward to it. Then let's look at discounts disallowed. Probably you want to pity Mr. Okafor by giving Mr. Okafor discounts. You understand? By giving Mr. Okafor discount. But Mr. Okafor failed to fail to apply to the conditions to that discount allowed, then you disallowed the discount. That shows that Mr. Okafor debt still remains the same, it does not reduce. Then here we are talking about debit note issued. Debit note issued. Please note this. We have what we call debit note and we have what we call credit note. Debit note and credit note is the concept of debit note here we are talking about is used to correct an overcharge, while the other one, which is the credit note, is used to correct an undercharge. Oh, but there is an issue in this formula, in this format. The issue there is, please, debit note issued is not supposed to be here. Yes, and I'm going to explain the reason why debit note issued is not supposed to be here. So this is not supposed to be the part of the format. Please be mindful of that. So it's not supposed to be part of the format. Hold on. I want to do something. So what I'm doing here is that the debit note is not going to be there. So we're not supposed to have debit notes here, like I said. So that's a typographical error from. So we can continue. So debit notes and the credit notes here. The debit note is used to correct an overcharge, while credit note is used to correct an undercharge. What I said debit note is not meant to be here is that we said our assumption is that anything under the debit side is to be increasing the debt. But when debit note is issued, it's supposed to reduce the debt, not an increase. Debit note here is in the sense that you are overcharged more than how much you're supposed to pay for the goods or services, probably due to an error or typographical error. You bought a goods that are worth 15 naira, but the receipt printout to you, maybe due to human error or machine error, you are issued a receipt of 500 naira instead of 15 naira, and you eventually paid for the good, or you eventually accept the price because probably maybe you are buying it on credit and you don't want to argue, some kind of situation. But later you realize that the value of the goods is 15 naira. So you can issue what we call debit notes. That means 450 naira is still with the seller or the supplier. You are the one having money with them now. So that's supposed to reduce the debt. It's not supposed to increase the debt. So that's why it's not here. It's not supposed to be. I'm sorry for that. Then payments to the debtor for claims of service charge. Service charges also increase the debt. Service charges also increase the debt. So let's move to the credit side of this sales and debtors control account. Under this side, we have check from the customers. Check from the customer means the customer pay part of the debt through what? Through check. That's going to reduce. It can be check or cash. It can be check or cash from the customer. Discount allowed. When the discount is allowed, discount allowed to reduce the debt. You can give out the discount. Maybe you give the conditions to Mr. Okafor that, okay, Mr. Okafor, you are owing me 10,000 naira. But if you can pay your 10,000 naira in next week, I'm going to give you 5,000. I'm going to give you 5% discount. That is discount allowed. That is when, if Mr. Okafor meet up to pay that debt next week. But if Mr. Okafor failed to pay that debt next week, the discount will be disallowed. It's not going to be discount allowed again. Then bill receivable, probably the person paid you through bills, can be through check. And when it is receivable, it's going to reduce the debt. Allowance is part of the things that can reduce the bad debts. I know you understand the concept of what we call bad debt. Bad debt is irrecoverable debt. The debts that you know that you cannot recover again due to some circumstances. Probably the person that your debtors might, something might happen to one of your debtors, maybe debt, maybe the person run mad or something like that. So you cannot recover that debt. So bad debt will reduce that debt. Return inward will also reduce the debt. You understand the concept of return inward? The goods that are returned back from the customer to the supplier. So that one will be deducted for part of the money you are owing. For the example, if you bought a goods that are worth 5,000 naira on credit and you discover that some of the goods that does not meet the description, or even some of the goods have expired. For example, if you buy an expired product, normally you will need to return it back to the customer. Then the value of the goods you are returning back to the customer, they will have to remove it from your total debt. It is in reducing what we call the debts. So credit note, which is the opposite of debit note, note that debit note is not supposed to be under the debit side for the sales or debtors ledger control account. That's a mistake from our own end. So please note that. So the credit notes issued is going to be under the credit side of the sales or debtors ledger control account. So which shows that there is what we call an undercharged. So in this case, it is no more an overcharge. So here is an undercharge. Probably the goods worth 50,000, and due to an error, they have to give you a receipt of 5,000. You're supposed to pay 50,000, but you pay 5,000. That means you are still whole. You are still doing what? The relationship is that is going to reduce your debt. So then we look at what we call contra entry or contra settlement. Contra entry, or we have contra entry, or what we call contra settlement. So here, I'm looking at how am I going to explain the contra entry and contra settlement to you so that you're able to understand it better. So that you're going to understand it better. So contra entry is a situation whereby you serve a same person is a debtor to you and that person is also a creditor to you. A single person serve as a debtor, at the same time that person serve as a creditor to you. Probably you are owing that person and the person is also owing you. That's what we call contra entry or setup. If you have this kind of questions, the contra entry is going to be both in your sales and purchase ledger account. The same amount is what you are going to post to the both sides. The same amount is going. I'm still going to explain when in our next video, when we are going to do the the normal format practical and example. This is just a format and explain the concept. When we are talking about balance CD, this shows that this is a balance carry down, which indicate that when we sum the total balance of the credit debit side and we sum the total balance of the credit side, then the difference between them is what we call balance carry down. The difference between the debit and credit side is what we call balance carry down. So let's move to the next slide now. Debtors and creditors side too. So the reverse is the case here. The previous one here, we have what we call sales ledger control accounts or debtors. So where the debit side is increasing the debt and the credit side is reducing the debt. But reverse this case when we get to purchase ledger control accounts, the debit side will be reducing the debt and the credit side will be increasing the debt, in the sense that balance brought forward, I've explained that to you. Credit purchase, that is, you purchase the goods on credit. Interest charges on the loan is going to increase the debt. Then dishonored bill is what I've explained as part of the previous concept. Then cash received from the debtors, that means the debtors pay part of their loan. Discount received will reduce it because you are the one now, you are receiving the discount. You return out for the goods that you return back to the company or back to the producer is going to reduce your debt. Bill payable, set off. Set off is the same thing as contra entry, and then I've explained what we call balance CD. Yeah, in the process of my explanation, if there's any that is not clear to you that I don't understand, you can drop it in our comment section. Then I'm going to explain to you or elaborate more on it on our comment section. Yeah, these are our key terms. These are our key terms. Balance brought forward is the opening balance, like I said. Sales / purchase credit. This shows that goods sold on credit or bought on credit. Goods sold on credit or bought. So I'm explaining these key terms to you and the concept of the format so that whenever you come across the question, you're able to solve it. So interest charge on overdue accounts. Interest charges is going to increase the debt. Dishonored, and we have honored bill. Bill of exchange not paid when due. That's dishonored bill. Then honored bill will be bill that are paid on when it is due. So we have carriage outward, delivery cost. I explain all these things to you in that format. We have discount disallowed, sorry. The discount request but is not accepted. Debit note issues is a document that is sent to the debtors, that they are still owing us more. So we have service charges too. So these are other key terms that we have here. So we have cash received from the debtors, check from the customers, discount allowed, and discount received. So I've already explained all these concepts in the format. And you can take your time. Probably, maybe if you don't understand what I explained, you can take your time and do what? And go through these keys to concepts in your video. You can pause the video and look at the concepts very well so that you're able to understand better. So thank you for watching. Please don't forget to subscribe to our YouTube channel, like and comment. If you subscribe, you're able to benefit from our upcoming video that we're still going to upload on our YouTube channel. Don't forget, this is just a part 1. The part 2 will be released too soon on our channel, where we are going to, where it's going to be based on practical, and we are going to solve some real example for you using board. So thank you so much.